If you're not investing in the US stock market, you are the sucker. Wealth is being served right in front of you, and if you're not in, you're getting left behind. Period. Here's why. Every year, trillions of dollars from around the world, China's trade surpluses, Saudi Arabia's oil money, Norway's oil fund, all of it flows into US assets. Why? Because Wall Street is the safest and most profitable parking spot for wealth. The US dollar is the global reserve currency, the US economy is the largest, and the stock market has the deepest, most liquid capital market on the planet. So if entire nations trust the US stock market to grow their wealth for their people, why wouldn't you? Follow the money, that's how you build wealth also. What if I told you there's a proven way to build real wealth on autopilot without ever stressing over which stock to pick? Sounds too good to be true. But here's the reality. Most people spend years and years trying to outsmart the stock market, and they lose. Even the so-called experts lose. But index funds, they quietly beat most of them year after year. In this video, you'll learn exactly how to get started with as little as $50 using trusted brokerages like Vanguard or Schwab. That way, you can watch your money grow for decades and decades to come and hopefully pass some along to your loved ones, or your children, your grandkids. Welcome back to the channel, Finance Philly, the place where we break down the smartest money moves, financial concepts, the wealthy swear by, so you can go from simply surviving to truly thriving. Today, we're going to dive down into one of the simplest yet most powerful investing strategies you'll ever come across. Index funds. If you ever felt overwhelmed by the endless stock market jargon or pretty much frozen by the fear of picking, the perfect stock, this video is for you. It's tailored for you. It is made for you. Because here's the truth. You don't need to be some Wall Street dude or some Wall Street genius or spend most of your nights analyzing charts or financial statements to build real wealth. What you need is a system, one that works quietly in the background while you go about your day. In this video, I'm going to walk you through exactly what an index fund is and why they outperform most actively managed funds. You'll learn how to choose the best brokerage, whether it's Vanguard or Schwab or Robinhood or Webull. You'll learn which index funds are perfect for beginners and how to automate your contributions so that you don't ever have to think about it. I'll also show you one of the biggest mistakes newcomers or new investors make when trying to dabble in the stock market, and a bonus tax tip that could save you thousands, maybe even hundreds of thousands over your lifetime. Grab a notebook, tap the like button, and let's build your financial future the smart way, the simple way, and the proven way. What is an index fund and how does it work? Let me ask you this. Have you ever heard that more than 80% of actively managed mutual funds fail to beat the overall market in the long run? It's the truth. Study after study proves it. Why? Because picking winning stocks consistently is incredibly difficult, even for the so-called professionals, right? They're often just guessing, charging high fees, and passing the risk along to you. Index funds flip this idea on its head. Instead of trying to guess which stock will outperform or which stock will skyrocket next, they copy an entire market. Indexes like the S&P 500, which pretty much tracks the 500 largest companies in the United States. Basically, an index fund is like a giant shopping basket holding pieces of hundreds, even thousands of companies that we all know all at once. So instead of betting your future on 1, 2, or 3 winners, you own them all. Apple, Microsoft, Tesla, Google, and so on. Why does this strategy work so well? Well, 2 big reasons: diversification and low costs. First, diversification. When you own the whole market, you pretty much spread your risk across many industries and businesses. So if one company tanks, dozens of others are still pulling their weight. Second, cost. Index funds don't pay expensive fund managers to manage your money or manage risky trades. They simply mirror the market, which means lower management fees and more money staying in your pocket. Here's the kicker. Historically, The S&P 500 has delivered an average return of around 7 to 10% per year since its inception. That means if you stay consistent and reinvest your gains, your money could double every 7 to 10 years, all without obsessing over stock charts. The real takeaway here is stop chasing the next big winner. Instead, own the entire market. It's the simple, time-tested path to building real wealth a smart way. Step 2, choosing the right brokerage firm. Vanguard, Fidelity, Schwab. So you understand what an index fund is, but where do you actually buy one? Here's where a lot of beginners get stuck. The brokerage you choose can make a huge difference, not just in fees, but in how easy it is to stay consistent. Let's break down the big 3 brokerages that millions of smart investors pretty much trust and use. Vanguard basically invented the modern index fund. It's investor owned, which means they have no outside shareholders. They don't demand bigger profits. Instead, they pass those savings back to you, and that's usually through ultra low fees. Vanguard is famous for funds like VTI or VOO. Those are index funds which come with the lowest expense ratios you'll find anywhere. Next, we have Fidelity. If you want zero barriers to entry, Fidelity is a strong choice. They offer zero minimum index funds, so you can pretty much literally start investing with just a few bucks. Their tools and mobile app are super beginner friendly, making it easy to track your progress and stick to your plan. Next, we have Charles Schwab. Schwab is another investor favorite because they offer a wide variety of index funds. They got great customer service and consistently low fees. They're known for making the process pretty simple, even if you're just brand new. So how do you choose? Well, you start by comparing expense ratios. That's the small annual fee you pay for someone to manage the fund. Lower is better. For example, Vanguard's total stock market ETF VTI has an expense ratio of about 0.03%, meaning on a $10,000 investment, you only pay $3 a year in management fees. Now, that tiny number can make a massive difference over decades. Also, check for account minimums, how intuitive the website is, and the quality of the customer support. The good news is opening an account with any of these brokerage firms is very easy. It usually takes about 15 to 20 minutes online. Then you can fund your account and pick your first index fund, and obviously you're officially investing. It's really that simple. Alright, so you've opened your brokerage account now, you're ready to go. Now comes the fun part, choosing which index funds to buy. This is where a lot of beginners overcomplicate things, but you don't have to. In fact, the beauty of index funds is their simplicity. For most beginners, you really can't go wrong here with a few classic choices. S&P 500, this is probably the most popular index funds for US investors or the world. It tracks 500 of the largest companies in America. Think Apple, Microsoft, Amazon, Google, all under one umbrella. Examples include Vanguard's VOO, Fidelity's FXAIX, or Schwab's SWPPX. Historically, the index has delivered on average a return of about 7 to 10% per year after inflation. Now, if you want even more diversification, you can go for a total US stock market fund. Now, this type of fund includes small caps, mid caps, and large caps. Basically, the entire investable market in one basket. Some examples are VTI, Vanguard's VTI, Fidelity's FSKAX, or Schwab's SWTSX. Now, this broader exposure can help reduce risk even further because you're not just betting on big companies. Then we have international funds. If you want to add global exposure, look into international stock funds like Vanguard's VXUS. This pretty much lets you invest in markets outside the US, which can be a smart hedge for long-term growth. Whenever you're comparing index funds, don't forget to check the expense ratios, that tiny annual fee that eats into your returns. It may seem very small, but a difference of just 1% in fees can cost you tens or even hundreds of thousands of dollars over decades. Now, here's the mindset shift. You don't need dozens of funds. 1 or 2 broad, low-cost index funds. Hold them for the long run and ignore the daily market noise. That's how you build real wealth. Steadily, automatically, and without stress. Here's where the real magic of index fund investing kicks in. Consistency. You see, the stock market is unpredictable. Up one month, down the next month, and trying to time it perfectly is a game even the so-called experts rarely even win. That's why the smartest investors don't rely on gut feelings. They pretty much rely on systems. One of the most powerful systems that you can use is called dollar cost averaging. I love this word. Instead of trying to guess the best time to invest, you pretty much commit to putting in a fixed amount of money at regular schedules, regular intervals. Say every week, every 2 weeks, every month, no matter what the market is doing. Here's why this works so well. When prices are high, your contribution buys you fewer shares. When prices drop, your money buys you more shares. Over time, this smooths out the ups and downs and helps you avoid the stress of market timing. But here's the real game changer. Automation. The easiest way to stay consistent is to automate everything. Set up your brokerage account to pull money directly from your bank account, your paycheck, your bank, whatever, on a schedule. That way, your future wealth is being built before you even get to see your cash. That's going to remove the temptation to spend it. So, how much should I invest? If you can aim for 10 to 20% of your income, that would be great, but don't let that number scare you. Even $50 or $100 a month is better than nothing. Because the real power comes from time. If you want some proof, if you invest $500 a month into an index fund that averages an 8% annual return, 30 years, you could have well over $700,000. Now, that's the magic of compound growth working for you while you're just enjoying your life. The takeaway here, don't rely on willpower. Build a system that invests automatically. That way, you let your wealth grow quietly in the background while you obviously live your day-to-day life. Now, even the smartest strategy can fall apart over time if you let your emotions take over. So before you start investing, you need to know the biggest traps that drain your wealth and how to dodge them and how to see them. Panic selling. Now, during downturns, the stock market will drop, sometimes by 10%, sometimes by 30%, or even more. But history shows it always recovers in the long run. Selling out of fear locks in your losses. The key is to stay calm and trust your plan. Chasing hot trends. It's tempting to jump into meme stocks, right? Crypto hype or whatever everyone's bragging about on the internet. But that's not a strategy, right? That's gambling. Index funds keep you grounded in real long-term growth. Next, paying for high fee advisors who claim they'll beat the market. Study after study shows that more than 90% of them don't. Index funds already outperform most active managers, and they do it for a fraction of the cost. Obsessing over daily price swings, terrible. Checking your account every day will make you go crazy, keep you anxious, and can even tempt you to make bad moves. Instead, check in once a month or once a quarter and focus on the big picture. Remember, the best investors aren't the ones who know every chart or prediction. They're the ones who stick to the plan no matter what. Patience and discipline always win in the end. Now, here's the cherry on top. The secret that lets your money grow faster than you ever thought possible. Using the right accounts to protect it from taxes. Obviously, taxes are like tiny leaks in your wealth bucket, right? Over decades, they can drain you. They can drain away thousands, even millions. But the wealthy, they know how to plug those leaks. 401ks lower your taxable income today. You defer the taxes until later when you might be in a lower tax bracket, i.e. you're not working anymore. Roth IRA, you pay taxes now, but every dollar of growth and withdrawal later is tax-free. Practically freedom. SHAs, the Triple Crown, tax deductible, going in tax-free growth and tax-free when used for things like medical costs. Smart investors use these as shields, letting compound interest work without obviously the IRS taking a slice every year. It's not about cheating, about the system, it's about mastering it. Now, protect your money, protect your future. Alright, let's bring it all together. Think of this as your new blueprint for building wealth. The simple, proven way that's made everyday people millionaires without the headache that comes with, picking stocks or timing the market or just being glued to a screen all day. First, you understand what an index fund is. It's not some fancy Wall Street product. It's pretty much your quiet partner, a giant basket holding hundreds, even thousands of companies. Second, you choose the right brokerage firm. Whether it's Fidelity, Vanguard, Schwab, Robinhood, Webull, they pretty much all do the same thing. Third, you pick solid index funds like the S&P 500 for core growth. Maybe you choose international funds, right? That way, there's no guesswork, just steady, broad growth. Third thing here is you pick a solid index fund like the S&P 500, international funds, VOO, triple Qs, whatever, right? That way you are diversified. All right, fourth thing here is you automate your contributions. This is pretty much your secret weapon. every paycheck, every week, every month without fail. Dollar cost average, that's going to let you buy when prices are high or low. And over time, the market's upward momentum works in your favor. Fifth, you avoid the biggest mistakes. You don't panic when headlines scream recession, inflation. You don't chase the shiny meme stock that everyone's talking about, that your friend swears will moon. You don't check your balance every day, because we all know wealth isn't built by watching numbers on a screen bounce up and down. And the bonus here is you use tax advantage accounts like a 401k, like a Roth IRA, SHAs. These are legal tax shields that protect your future gains from taxes that can drain you dry. Obviously, look, wealth isn't a lottery ticket. It's a wall you build brick by brick, contribution on contribution, year by year. Index funds are going to help you build that wall while you live your life. So don't wait for the perfect time, because obviously there isn't one. The perfect time is the moment you do decide to start investing, which is today, maybe tomorrow. Your future self will thank you. Trust me. Now that you know how to invest in index funds like the pros do, here's your next step. Don't stop here. Index funds are the vehicle, but compound interest is the fuel. It's the magic that makes everything work, that makes your wealth grow in the background year after year. So click on my other videos here, understanding compound interest. If you don't know what that is, or just any of them, they're bound to educate you a little more. Anyways, if you made it to the end of the channel, I do appreciate you. Hit the like and subscribe button for me, and I'll see you guys tomorrow, or see you on the next one.